And at the forefront of the reasons why, global slowdown concerns as the U.S. bond market flashes a recession warning. Germany's economy shrinking in the second quarter. GDP contracted 0.1% in the 3 months to June as global uncertainties like Brexit and U.S.-China trade concerns weigh heavily on markets both here in the U.S. and across the pond. China also reporting weak data as the jobless rate rebounded in July to its highest level since regular reporting of the data began, according to the Wall Street Journal. So joining us now to discuss is Raymond James Chief Economist Scott Brown. And Scott, I want to ask you first, given today's inverted yield curve, what do you make of this unsettling global data and the market's reaction?
Well, there's nothing magical about the spread between the 10-year and the 2-year Treasury notes moving below zero. What matters is the slope, and the slope has already been flattening. And as it flattens, the odds of recession increase. And so you are looking at increased downside risks, and a lot of that has to do with the outlook for global growth. You're seeing weakness, obviously, in China and Europe. You've got Brexit coming up. You've got trade policy, which is pretty uncertain at this point. We had the May 10th increase in tariffs, which really kind of hit industrial inputs a lot more. So that's very disruptive to supply chains, very hard for U.S. manufacturers. And now we've had some delay in terms of this latest 10% tariff, which was supposed to go into effect September 1. That's now delayed till around Christmas, and that provides a little bit of relief. But it's obviously a little bit of concern, and I think we're seeing a lot of headlines today about the 2-year, 10-year spread, and that's really kind of adding a lot more to the anxiety level.
Hi, this is Carlton English. You mentioned that some of the relief in tariffs, are kind of easing things a bit. But what about, if the Fed decides to go ahead with a 25 basis point cut or even a 50 basis point cut? Would that, help with the chances of recession?
Well, I think we've seen the stock market be really hypersensitive to even minor changes in the Fed. But I think the market's gotten a little bit ahead of itself with the Fed. It does look likely that we're going to see a rate cut either at the mid-September meeting or at the meeting in late October. But certainly if the market expects or demands a rate cut, it would be very unusual for the Fed to disappoint the markets. There is some debate about whether a rate cut is going to really do much good in terms of stimulating growth. In terms of business investment, no businesses are really worried about interest rates in terms of the decision whether or not to expand. But it's that global growth environment. And at some point, these firms could become even more cautious. So instead of just, postponing expansion plans, curtailing capital investments, maybe they start laying people off, hiring people at a lower rate or whatever. And that shows up in the job market. We may be seeing a little bit of sign of that. The pace of job growth has slowed this year. You've had a little bit of an increase in corporate layoff announcements for several months of this year. But it's still pretty low. The job market is still pretty strong. But if these global worries continue to build, if we don't get a resolution on trade policy, the outlook, I think, for the U.S. economy is obviously a little bit weaker as you move into 2020.
So we're seeing this signal of a recession, but I want us to get out of it immediately because who wants to see a recession? You're talking layoffs, hiring freezes, really bad situation. So what do you think the Fed, you were talking about the Fed before, but aside from easing monetary policy, what kind of resources does the U.S. have to stimulate the economy to possibly prevent this recession?
Well, it's kind of interesting because we're not seeing the kind of excesses that we would normally see in front of a recession. You don't see a high degree of leverage out there, certainly in comparison to the housing bubble that we had. But at the same time, if we do run into a recession, the tools to fight that are a lot more limited. We've only have 200 basis points to work with in the federal funds, where they normally would lower rates 500 basis points during a recession. So they're very limited in terms of what they can do. That means that they should probably be more aggressive in lowering rates if they think they have to. They could also do quantitative easing. I think a lot of people are talking about moving to negative interest rates. It's probably a lot too early to talk about that, and I don't think the Fed's really going to be inclined to go negative on short-term interest rates. But at the same time, the fiscal stimulus is also going to be very, very limited. We're running a federal budget deficit now of right around $1 trillion per fiscal year. And if the economy weakens, then the deficit's probably going to rise to maybe $1.5 trillion, maybe $2 trillion if it's a really bad recession. And you're not going to really see much prospect for tax cuts or increased government spending in that kind of environment. And in fact, they may go the other way. People start worrying about the deficit and they start either raising taxes or cutting spending, both of which would be contractionary. At the same time, there's also state government to worry about. And as we saw during the last recession, these states all have balanced budget requirements. And so if the economy starts to weaken, the revenues dry up, they're forced to cut into spending. And that makes the recession worse, the recovery weaker. So I think there's a lot to worry about for investors. We still think that the consumer is going to carry the day, at least in the near term. But it's the balance of risks, the global concerns, the trade policy uncertainty, which are pretty big negatives right now.
And the concern that the Fed might not have much more room to move should this worsen. But Scott Brown, we got to leave it there for now. From Raymond James, thank you so much for taking the time.